Adam, I want to ask you about the 10-year Treasury yield, because the trading range in July has been something like the lowest since 1973, around about 7 basis points. Why have Treasuries been in such a range?
I think it's because markets are, as they're priced at the moment, thinking that we're in, as a central view, the tail end of the Fed tightening cycle. So the forward curve has the 2 rate hikes this year that the Fed is guiding us towards, but little priced in beyond that. And that's where I think we diverge from the forward curve, and our own view is much closer to the Fed's dot plot, where actually as we go into next year, which I think is the debate we have in the second half of this year, the Fed is much more likely to continue tightening policy at roughly the pace it's been doing this year. Now, if that's the case, that will put some upward pressure on longer-term interest rates, and that indeed is our expectation. But I think what's capping rates at the moment is that the Fed, or the market view of the Fed, is that we are in the end game now of the Fed tightening cycle. We generally don't agree with that.
What does that mean then for dollar strength going forward? Does it track what rates do, or has it become disconnected from the rates market?
On our view, it tracks it. And as I say, I think we're in quite a conventional world at the moment, where monetary policy is driving FX markets and policy is still diverging in favour of the dollar. That, on our view, is true going forwards. There are no doubt risks to that, but I would see the worst case scenarios in terms of global trade as risks rather than a central scenario. And for us, H2 plays out much the same as H1 did, which is the dollar outperforming versus all of the major currencies, rather than underperforming, which is still, I think, the consensus expectation.